Yo, ladies and gentlemen, I greet you all and I hope everyone is doing well. I'm back again with another lesson on the 3.0 course. So without wasting any further time, I'm going to start by defining what is it that is actually meant by maximizing profit. The biggest mistake we can do is to discuss maximizing profits without starting with the limitation of losses. If you want to maximize profits, obviously what's important, you must know how to minimize your losses. This is the most important part that you guys must know. So since this plays a major role in us even getting to make profit, we can say the lesser losses you make, the greater the opportunity of you in making profit. Simply by understanding how to order a stop loss, you can actually control your money loss and make greater returns. When we talk of maximizing profits from the market, we talk of ensuring that you get all the pips, as many as possible, from this each and every single trade that you would have entered in the market, depending on the trading instrument that you have chosen at that time and moment. I hope you guys understood the concept behind maximizing profit. So we as traders, we are all different. You guys know that. We as traders, we are all different. This is something you must note each and every time. In Forex, we have many different types of traders who use different trading styles to profit. However, for this lesson, we are only going to be focusing on scalpers and swingers. So we have scalpers and we have swingers. Those are two different traders that we're going to be focusing on for this lesson until we finish. So then the question then rises to a person who's looking into this: what is scalping? So scalping involves the buying and the selling of trading instrument or any trading instrument. Typically a brief holding a time and with multiple trades that are taken each and every day. So they keep the risk very small in an attempt to capture small price movements for them to profit from that particular trade that they would have taken. So on the other side, we have swinging, which is swing traders or the swingers. The swingers on the other side, or the swing traders or swinging, is a trading strategy that involves holding a position for a longer period of time. So it's longer than a day. Again, if a trade seems to be going bad, swing traders can exit the market before losing too much money on that particular trade. An average swing trade can hold a position for 3 to 10 days, and ensuring that they are taking advantages or they're taking advantage of any positive swings in the market. So basically, taking advantage of any positive swings in the market means scaling in between. They flow with the market, taking little trades that are presented to them during their swing. So you can now tell the difference between scalping and swinging. You can tell now the difference between a trader that scalps and a trader that swings. Let's move forward. So the question then that I want you guys to know, or that question that I'd like to ask you guys, and I'm gonna give you actually how many minutes for you guys to think about it. I think I'm gonna give you a minute for you guys to think about this, and then I'm gonna give you guys an answer to that question. So the question is, after learning the difference between a swing trader and a scalper trader, which of the two would you think maximizes more profit from a single entry, and why? So after learning the difference that a swing trader is a person that holds a position for 3 to 5 days, and again that person can always exit out of the trade, and then learning that also being a scalper, you hold trades briefly and you take a lot of trades at the same time. So which one would you think is mostly likely to be maximizing more profits than the other, and why? Let me give you a minute for you guys to think about it. Thank you. Your minute has collapsed. So let's go to the answer. This is the answer to the question that I've asked you guys on the previous slide. So the answer is that a swing trader is the correct answer because they hold a position longer. That's the first thing. They are able to exit the market before losing too much money. That's the second one. They take advantage of any positive swings in the market. That is just scaling in between the markets. They flow with the market, taking little trades that are presented to them during their swing. Thus, doing so helps them to profit more from a single entry instead of looking for many different trading instruments to trade and for a short period of time. This helps them to understand the full movement, or rather the direction of the market. Hence, taking advantage of such is easy, thus maximizing all the pips that are presented in their face and helping them not to lose focus during their trading. So you can easily lose focus when you are trading a lot of different trading instruments at the same time and for a very short period of time. So it's very much easy for you to lose focus and not to know what's happening on the other pair. However, with swing traders, they do not trade as many trading instruments as possible, but they always try to ensure that they focus on those particular instruments that is presented in front of them at that time and moment. Moving right along, I can conclude by saying maximizing profits requires an extensive, or rather a comprehensive skill of learning how to hold trades, knowing the entry and the exit points of all the elements that are surrounding holding those particular trades. Moving right along. So now, when you're maximizing trades, you must know the difference between the possibilities that are presented to you by the market and the probabilities that are presented to you by the market. Then a person says, Jaguar, I do not know what is a possibility and what is a probability in the market. So a probability refers to the likelihood of an event happening. In general English, that's it. It refers to the likelihood of an event happening. That's just general English. However, in Forex, it refers to the likelihood of the trading instrument moving in the direction of that trader's prediction. So this is backed by the strategy that that particular trader is using at that particular time and moment. And then you must take note and caution of this. No Forex trading strategy is 100% accurate. So this opens up for a possibility. We will have a high probability trade most likely to happen and a low probability trade that is less likely to happen. That low probability trade is then a possibility of what would happen if the main probability doesn't happen. I hope you guys understand this concept like straightforward. And please listen to me when I talk each and every time and try to screenshot and still reread what I've written down here. In that case, it's going to be much more easier for you to understand the difference. And then a possibility. A possibility, it's a thing that may happen or may be the case. However, in Forex, a possibility comes right after the probability. A possibility is what may happen if the probability fails. It is the secondary option from the probability. Since no one can say their Forex strategy is 100% accurate, so this leaves a room for disappointments, which comes with what? With possibilities. I just really love this differentiation between the two words. I hope you guys at home, I hope everyone who's reading this and who's listening to this will also enjoy the difference in between. But what is Forex without setting out examples that are just on the chart where you get to see what is it that is Jaguar is talking about? I hate it when we only when we only do theory. I want us to get things into practicality. So there's an example of maximizing profits. You can tell it was published on the 16th of August 2022. So this is a live chat. This is an event that took place This is something that transpired. So I was trading USD JPY. So USD JPY, as you guys can see, at the time and moment I was applying my strategy, the one that I trade with, I realized that we were at the support. So I made sure that like I highlight all my supporting areas. Or as a support, now the very same support that I had here was not respected here. And the very same support, what happened is it tried to break, but it didn't break. Now my support is now a resistance. As you can see, now my support is what? Is a resistance. So according to my strategy, looking into this, looking at the fact that I had a support and I failed to respect that support, what will make me to respect it here? So then that's where I then said there's a possibility that it might buy, but the probability, according to my strategy, what I deem happening 100%, like I would say 100%, I deem this happening. However, leave the room for disappointment. So I'll say 99%, I'm saying it's going to sell. But leaving the room for disappointment, I'd say the 0.01% is going to a possibility. So why I'm saying this is a high probability? First thing first, we failed to break here. What would make us to break here again? So again, we are on a what? We are on a diagonal supporting a trend line, and we've tried to break that diagonal supporting trend line for several times. It's then telling me that right now we've gained enough momentum, enough buyers were induced on this trade, for them. They're gonna keep on buying even now because they can see that oh wow, here we bought. What would make us not to buy here? But one thing you must understand, this trade is already exhausted. They already know that every time when you get to this diagonal supporting trend line, you buy, and it has happened for quite some time now. So they now are like, no, now it's time we eat on the sellers now. We eat on the buyers now because the buyers are already taking opportunities. Now this is just way too obvious. So market makers always make sure that they don't want something that is way too obvious. They want to make sure that when it's too obvious, they go against the too obvious. This is the results. Guys. This is the result. The result is that the probability, the likelihood of it happening really happened. You can tell we didn't even spike, nothing ever happened, but we were creating some sort of a double top formation. Then we sold, and then I took profit and enjoyed. Understanding the difference between a possibility and a probability will help you grow even more in the forex market and even more into what's the understanding of your trading, or the understanding of the market as a whole. Because now when you know that there are possibilities and when you know that there are probabilities, in that case you might be wrong, but from being wrong you will learn from being wrong and know that damn, that wasn't a probability, it was supposed to be a possibility. That wasn't a possibility, it was supposed to be what? A probability. So in that case you win either way, because now you know if it was a possibility, why did it become a possibility? Why is my probability failed? If it was a probability, why did my probability win? Why was the possibility not winning? That means my strategy is more accurate. Then I keep on using that strategy that I'm using. Moving right along. So then the person will then ask Jaguar, how does this whole thing help me towards maximizing the profit? So knowing the difference between the possibility and the probability, and being able to spot the possibility and the probability in the forex market will help you know whether it is a good trade to take or not. A high probability trade has a lot of confirmations which confirm the direction of your trade, whereas the low probability trade is the opposite, and what can be seen as a possibility of what might happen or take place when the probability doesn't happen. And where else the low probability trade is the opposite and can be seen as a possibility of what can take place if the high probability doesn't materialize. And sometimes the chances can be 50-50. So sometimes you can have 50-50 chances. It just requires you to wait. Whenever you have 50-50 chances, you must just wait. The high probability trade can be held for long, thus assisting the trader to maximize his or her profit. So when you're having a high probability trade, that's where you can know, damn, here I can hold for a longest time. In that case, I'm able to maximize my profit. So what happens when you do not maximize your profit? So now, sometimes you do not maximize your profit. So there's now things that happen to you if you do not maximize your profit. And I want you guys to take note of this. When you do not maximize your profit, you leave the large sum of money, which is called the pips, in the market that could have easily been taken advantage of, guys. When you do not maximize your profits, you leave a large sum of money from the market that you could have easily taken advantage of. You also happen to close on small profits, and you are likely to close big losses as opposed to the profits you take, which promotes your account to blow as opposed to it growing. So that is what happens when you don't maximize your profits. You are always gonna be closing the small profits, and also it's highly possible that you're gonna be doing what? You're gonna be closing big losses because you do not know the difference between the probabilities and the possibilities from the market. So these are the benefits that comes with maximizing the profits. So the benefits that you get is that you are able to take advantage of all the available pips upon entry. That's the first benefit. The second benefit, your trading experience grows more because you know you are knowing all the steps that you must take when you're trading. So you knowing your stop losses, where to put your stop losses, and where to put your target points, which are your take profits. And you can differentiate between a swing and a scalp trade. And you know where to scale in and add more trades as you move with your longs or shorts, taking advantages or taking an advantage of all the pips that are made available for you at that time and moment. So maximizing profits. So the skill that can be used by any trader to help maximize the profits. This one I will really have to go to the smartphone MetaTrader 4 to explain to you thoroughly as to how to do this. So the first thing that a trader can use is entering two trades of the same trading instrument. So you can enter two trades of the same trading instrument. For instance, the same currency pair, close one and let the other one run until the desired destination or the number of pips is reached. That's the first thing that you can do. Secondly, is to hold and update the stop loss and put it above or below the entry, depending on whether the trader took the longs or the shorts. I'm also going to be using the MetaTrader 4 smartphone app to demonstrate and show you guys what do I mean by this, because when I'm saying it like this, it becomes way difficult for you guys to understand. It's a very complex subject. It can be a little bit tatazeli. So the other method that you can use is when a trader has opened, for example, lot size 0.20 in one pair, or 0.20, that's a perfect way, a correct way to call it. The trader can be able to close 0.10 and leave the other 0.10 profit running. Also, I'll have to do a demonstration on MetaTrader 4 to show you guys what do I mean by this. Ladies and gentlemen, this is the flip side. As I told you, I'm going to do an example showing you how to maximize trades using the skills that I had mentioned previously. That will help you. For the purpose of the video, I decided to deposit the amount of 20,000 into this account, and then let me show what do I mean. I've already made like 2,000 rand profits from it. So the first example that I told you guys about was that you can add two trading instruments of your choice, and then from there it can be the same currency pair that you choose, or the trading instrument that you choose of any of your choice. And then what should happen is that you can close one currency pair or any trading instrument that you have, and leave the other one running at the time and moment. So as you can see right now, I have two also trading instruments that I'm trading at the time and moment, which is US state, which falls under the indices. It's a very volatile pair. As you can see, the prices are fluctuating very fast and very quick. So as you can see now, I have two. The first example that I gave you guys is that you can close one, and I have closed one right now. I've closed one. The other example that I gave you guys is that you can do what? You can hold and put the stop loss below or above the entry, depending on whether you took the longs or the shorts. So I'm going to go to my trade right now. And check where can I update my stop loss to be. So at this time and moment, since I'm selling, the stop loss will be below the entry. So let me go and check where can I put my stop loss. I'll now have my stop loss at 33,128. So that's where I'm going to be having my new stop loss. So it's going to be 33,000. It's going to be my stop loss. I'm just doing this for the demonstration and for you guys to know what is it that I'm talking about. Obviously, the pips are very small. They're very short because I just opened this account now, and I'm doing this for the demonstration for you guys to understand what is it that I was referring to. So there we go. The stop loss below entry, my stop loss point is now going to be 33,128.70. 128.7. So I then go to modify 128.7. So now when I go to modify, I can modify my stop loss and make it to be that point where I want it to be, where I now say even if it can hit my stop loss, it's still gonna close me on profits. If it hits my stop loss, I'm happy, I'm not gonna cry. It's gonna close me where? On profits. The other example, which is the last example that I did, said if you are running a 0.20 on a pair, you can literally close only 0.10. You can only close 0.10. See, for example, here is it. You can close only 0.10. Done. There it is. There it is. I was able to close only 0.10 from the entry. I'm still having what? I'm still having 0.10 running, of which I'm still hoping that with this 0.10, I can still go down with my entry. I can still go down and enjoy the profits. In that way, I'm able to maximize as much profits as possible. At the same time, I'm protected because I have a stop loss that is above entry. Guys, this is the most perfect strategy you guys can take. You can tell right now. See, I'm on 4,000. I was able to close that. I'm happy right now. I was able to close today 4,000 profits from this account that I just opened. As you can see, the time it's 11:26. I just opened this account now at 10:15, 15 minutes past 10, at 10:15. And I'm enjoying the profits and the benefits of trading this account right now. I'm enjoying each and every profits that I'm getting. If I'm saying now I've taken enough, I can simply just go and say I've maximized my profit. So I've now maximized my profits. I'll check now, okay, fine, where's my take profit, where's my stop loss, where's my take profit. I can now say, for instance, I want this to run until it gets here. I want it to run until it gets here. 33,018.40. Yes, 33,018.40. Now my take profit is correct. So I'll wait for it to hit my take profit, because that's what I'm anticipating. That's where I see my probability going to. So, and I know I have a stop loss that is below entry. I'm still protected. That's it. So if I'm also happy with my profits, because I'm swinging, you remember it's a swing, I'm using the swinging strategy. If I'm happy with the profits and I'm seeing that I want to minimize my losses, I can always just close the entry and say I'm happy now. I'm happy now. 28,000. I'm happy. I've made 8,000 rand profits. I'm excited. I'm happy. That's basically it. So, ladies and gentlemen, thank you so much. That was the lesson. I wanted you guys to know this and to practice it at home, as I did, as I'm showing you on a live account. You guys were looking at it, and that is it. Thank you. Moving right along. This is now the conclusion and the end. In conclusion, it is important to master the Forex psychology and the Forex trading strategy that you are using at that time and moment. This plays a major role in Forex trading in general. Hence, it helps you to know when to enter, exit, and maximize your profits. Also, because holding too long can also lead to losses. Yes, it can. Sometimes holding too long can also lead to losses. But if you know your entry and your exit points very well, and you apply the proper risk management and good psychology, in that case, you're gonna escape from such. The psychology helps you to manage your emotions, while the Forex trading strategy helps you to know your stop loss points, your scaling in points, and your take profit targets. Guys, this is the conclusion and the end of the lesson. I hope you guys enjoyed and you guys are happy with the lesson. It's the Omari Jaguar, the Omari JJ, the trader from the villages, the only goat that is a Jaguar, Umalume Forex, signing out.